All right. Welcome. My name is Ludovic and I teach asset management and private equity here. And I've been doing research in private equity for about 15 years. So what I want to do today is to show you the latest investment committee at CalPERS. It occurred on August 17th, so a few weeks back. And CalPERS post their investment committees or board meetings on YouTube when they are open to the public. So that's the case here. And what we're going to watch is the segment where the private equity team is invited to come in front of the board and the subcommittee of the board, the investment committee, to talk about private equity fees and to make a presentation on these fees, these structures in private equity. So what I'm going to do is that I'm going to play this video. If you want to see it later, you need to look for Investment Committee Part 2 or just CalPERS in YouTube. And it's starting at minute 55 on that video. The goal of this presentation is is to tell the investment committee how fees work in private equity. Not an advanced presentation, but a basic presentation about how basically fees work in private equity in a simple example. Yeah. To put this in context, CalPERS has been investing in private equity for 25 years, invested $50 billion in private equity, and the subcommittee in the board, which is in charge of the investments, so the more specialized people in the board on the investment side, asked for a meeting to understand what is the basic fee structure in private equity and how that works. Okay? Now, better later than never. Okay, so very good. Fees are very important, so that's a good thing. Okay, but that's the context. Okay, and a lot of pension funds, to the credit of CalPERS, are not having any such presentations, and they probably should. Okay. So the presentation started with Réal Desrochers, who's the head of a private equity at CalPERS. And what I want to do is that I want to play Réal Desrochers as if I would have been him in that presentation. What would I have said to the investment committee? How would I have presented things? And you can compare his presentation to mine. I'm going to do this on each of his slides. So the thing is that I believe Réal Desrochers is Canadian-French, which Canadian French are just like French people. They're just a bit nicer. So the way I'm going to do this is that I'm going to try to be nice and at the same time have a bit of a French accent, and I should cope, I think. So that's what I'm going to try to do. So I'm here in front of a board. You guys have a board, and I'm going to tell you how private equity works. I would have probably started with that picture, which is I'm not going to go into the details. But basically, there is a fund here sitting on the Cayman Islands. There is a general partner and an investment advisor sitting in New York or in London, and portfolio companies that are registered like in Delaware or other places like that. And there are three sources of fees, three big ones. One is this carried interest that is going to be the topic next in that presentation, the management fees that was covered here in this presentation, and these portfolio company fees that he hasn't mentioned. There is another video on YouTube from last year where I talked a lot about these things, so you can go ahead and read about that. We won't talk too much about them. We're going to focus on these two, just like in his presentation. Now, what are management fees? So management fees, in theory, at the time at least, it was like this thing that you're supposed to get so that you can just keep going, that like you pay your rent, that you pay your fixed salaries, that you pay your expenses, right? And you're supposed to make money only via this carried interest, which is a performance-related fee. So the management fees is supposed to be what covers your expenses. And he's mentioning that 2% is a bit on the high side of things, right? He says 2% is on the high side. He's going to repeat that a few times. Now, historically, which is the purpose a bit of that presentation, what happened historically, how much fees have we paid, it turns out that it's exactly half of the funds have more than 2% of management fees and half of the funds have less than 2% management fees. It's exactly the average historically. So actually, the 2% historically is a very good guess. It's exactly the historical average. Nowadays, yes, it's more towards 1.5%. The thing that he hasn't mentioned, and he didn't get into the details of that, is that in fact, these fees are not charged on the invested capital. They are charged on the committed capital. That's a big difference. If you give $100 to a mutual fund, and they charge 2%, they invested $100, and they take $2 every year. In private equity, you commit money to a fund manager, and that guy calls the money when he finds something. Okay? And that makes a lot of sense because you don't want somebody to just rush and just buy stuff in illiquid markets. So imagine it's a real estate fund, for example. You wouldn't tell someone, here is $100 million, just go ahead and buy for $100 million of buildings, like now. And then like within 2 weeks, the guy got $100 million of buildings and then can be paid 2% of $100 million. You don't want that. So what you want instead is go and shop. I give you up to $100 million. It's like a credit card. Find buildings. When you find one, you give me a ring. I send you the money. And therefore, I will pay 2% on the capital committed. So I will pay 2% on the $100 million that I told you to go and deploy. You have 5 years to deploy it. That's what we call the investment period. You have 5 years to invest my money. And I'm going to pay you 2% of the committed amount. What do you think that means in terms of fee bill compared to a mutual fund? So for example, if you go to the data, you will see that on average, when somebody has $100 million to invest in private equity, they invest about $20 million a year for 5 years. So they invest linearly, right? Every year they spend 20. And the divestment happens about regularly like this as well. They hold things for 4 years on average, and so divest at regular pace as well. That means that a fund, at any point in time, is invested at 50% of the capital committed, right? If you invest linearly and divest linearly, at any single point in time, this fund is effectively 50% invested. So if you pay 2% of fees on capital committed, how much fees are you paying on capital invested if it was 2% of capital committed for over 10 years? 4, right? That's a 4%. That's comparable to the mutual fund, right? So that's one of the things that one has to remember in private equity is that the headline fees are not quite what you're going to get. You have to read all the footnotes, all the definitions, and different people are going to have different footnotes and different definitions, and the fee bill is going to be very different across people, even though everyone says, I'm charging $220 with 8% hurdle, right? In fact, the effective fee bill is completely different across people because of the footnotes and the exact definitions. So usually it's not 4% on invested, the fees in private equity, because we change the basis of the fees from committed to invested after 5 years. So after 5 years, you do get pay fees on invested capital, which makes sense because then you don't have an incentive to spend all the money because you're done. The investment period is finished. Now you have invested, and so now I'm going to pay you fees on the money that is still going. You do have a bit of an incentive to like hanging on to investments because if you divest them, then you lose your fee. But you have at least a change in basis, which basically means that the fees are going to go to 3% effectively, right? It's going to be a 4% during 5 years of capital committed, and then the next 5 years is going to be on invested, so at 2%, and so you're going to be at 3% a year like that, right? So Real de Rocher doesn't make that explanation, right? He abstracts from that, and he doesn't annualize numbers. So you have this, 20 million, and you don't know if it's a big number or a small number. If you say 3% a year, and that's equivalent to a mutual fund, that already, that tells you something a bit more precise, yeah. The other thing that is important is that he repeats a few times that 2% is like in any other asset class. Did you catch that? He repeated twice. He said it's like any other asset class. Indeed, the average mutual fund in the US charges 2% a year. The average hedge fund charges 2% a year. So then he uses that saying, like, look, it's just like anyone else, so don't be scared by that fee. If he would have explained that it's on capital committed, and in fact we are talking about 3% on capital invested, that's not like any other asset class. That's actually the most expensive one, by far, on fixed fees, right? So by not presenting it in the right way, you also like make a statement like this, saying it's 2% like anyone else. It's not. The footnotes, so like one of the things to check in the definitions, for example, is what is the definition of capital committed? And in particular, is the fee that you're going to be paying part of a capital committed or not? And this is another mistake that was made in this presentation. In the presentation, there is a footnote that says, this fund has $120 million of capital committed. That is written at the bottom of the slide. $120 million of capital committed, if there are 2% fees, it should have been 2% of 120. Okay? Now, if the definition of capital committed is the capital that I will invest excluding fees, then yes, indeed, you would pay 2% of 100, and 20 would have been put aside for fees to come on top of the 100. And that very small difference in definition of capital committed, does it include fees or not, can change your bill dramatically from like a 4% annual to a 5% annual if the fees are not included in it. The carry is usually 20%. Again, apparently it goes back, apparently this 20% is in the Bible somewhere. It's the Venetian merchants, they were taking 20% of the profits when they were like doing trade with India back in a long time ago. So 20% is like a magic number apparently. Hedge funds charge 20%, private equity guys charge 20%. That's a magic number. 90% of the people in private equity charge 20% carry. So now the thing is, like you know now, you need to pay attention exactly how things are calculated and so on, so that like you really understand how things work. And in particular, this issue of a hurdle and so on will be quite important. So we need to define very carefully what's a profit. So profit is the total exit proceeds minus a so-called carried interest basis. This carried interest basis can be expensive, and it's expensive when it's a US style, and it's cheap when it's a European style. And they give different incentives. So the US style is that whenever you exit an investment, you take the cost basis of that, and you just add them all up, and this is your cost basis for your carried interest. What that means is, if you make 10 investments of, let's say, $10 each, one of them goes to $20 the next year, you exit that investment, the basis is therefore 10, that's the investment of what you have exited, and you have returned 20, so you earn 20% of the 10 of gains, you earn 2. Okay? So with an American basis, you can start exiting your winners quickly, and you're immediately in the carry, and you start earning a carry. Okay? Because if the basis on which you're going to calculate that is the ones that you have exited only. So you're going to hold on to losers and exit winners first, and that's going to be maximizing your carry, right? So you have its incentive a bit with the American structure. And on that structure as well, if you exit your winners first and hold on to your losers, you need to be very careful whether there is a clawback provision, because you may have earned a carry, and at the end of the fund's life, you're below the hurdle, and then you need to give money back to investors. And so you need to check if there is a clawback or not. And if there is a clawback, how much money is going back to you? Is it exactly the amount of money that you gave to the GP? Usually not. It's minus the taxes they had to pay on the carried interest they earned 8 years ago, and without any interest. Nowadays, not a big deal, but at some point, other points in time in history, it would be. Okay? So that's extra complications as well, things to check, and so on. And then you subtract management fees to the amount of money distributed when you can calculate the carry. But there as well, there are some subtleties that you need to check. Is that the management fee that I actually paid, or is it the one that I was due? And that will go back to portfolio company fees and a question later on in that video, that actually you have a management fee that is due, which is this 2%, but because there are a number of like waive rules for management fees, you effectively pay basically zero of management fees. And so if it's in fact management fee actually paid that you subtract from the carried interest, it's going to be very expensive for you compared to if it's a management fee due that you subtract from the thing, right? So that's just to give you a flavor again about the kind of details and that need to be checked, and that these details can make a bill completely different and very expensive or very cheap. Now the CIB can also be what we call European style, and things are becoming more and more, nowadays people are adopting more and more the European style CIB, and then it's capital committed. So it's like you can exit this investment after 1 year for 20, but until you have not returned to me the capital committed, you cannot earn a carry. So if I committed 100 to you, you can exit that one guy for 20, you still don't earn anything. You need to exit another at 20 and so on. Once you have exited 5 at 20, then you gave me my capital committed back, then you can start earning a carry. What that creates in terms of incentives is that it gives an incentive to exit a lot of things actually pretty fast as well, to get to refund the committed capital as soon as possible so that you get into the carry also pretty quickly. So that also has some perverse incentives, but usually it's a bit cheaper as a structure, right? But again, and you need to check the definition of capital committed, etc., right? And then there are these hurdle rates. In a presentation, it repeats several times. I abstracted from the hurdle rate. There is an 8% hurdle rate. That's very important. It's 220, 8% hurdle. What most people think the 8% hurdle is that you will earn a bonus for what you generate above 8%. If you've worked in about any job and your target is 8%, you'll get a bonus on what you generate beyond your target, the 8%. In private equity, you have something that gets added there, which is called a catch-up. It's a footnote, and that footnote basically cancels the 8, and you get money from 0. 8 is just what you need to cross at one point in time, and you earn from 0. I would explain that. So again, one slight detail, if it is 100% catch-up, which is usually the case, nowadays a bit less, but in the past it was the case for CalPERS funds, the 8% hurdle doesn't matter. And the reason he abstracts from it is not to be generous or like to make it simple, is that the hurdle doesn't matter in this example. Whether it's 8% hurdle, 10 or 0, it would be the exact same amount paid because you don't get a carry beyond the hurdle. You get a carry from 0. The hurdle is just something you need to have crossed at one point in time. And on this example, the hurdle wouldn't have made any difference. So the idea is that you don't get any carry unless you get an internal rate of return of 8% net of fees on the fund, right? That's what is the hurdle. And there are all kinds of issues with that. You will learn a bit in your corporate finance course and then later in my private equity course, the problem with IRR and how you can game an IRR to make it, to cross the 8% relatively easily. So then the expensive footnotes there is that this catch-up provision. So if you have a 0% catch-up, it would basically mean that in most cases you would earn money only beyond the 8. But if you have a 100% catch-up, it basically means you earn money from 0, right? So again, this is an example of these footnotes details that change the bill a lot. If a fund has 10% return after management fees, but before carry, if there is a 100% catch-up, you pay 2% of carry and you end up with 8 of net returns. If there is 0% catch-up, you pay 0.4 of carry and you get 9.6% of return. These are huge numbers. If any one of you worked in asset management, can satisfy. These are big numbers. When for a year it's a 1.6% difference, and this is a big number. Okay? And that's all down to one footnote somewhere. They all have 8% hurdle, but one footnote saying there is a catch-up, 100% or 0%. Right? So that's for the carry hurdle. Now let's go to Excel and do an example that is a bit more detailed than the one that Réal Desrochers has presented. So to be a bit more realistic, I'm going to take a fund that has, like he does, 100 of capital committed. I'm going to assume to be a conservative in my estimation of fees, that this 100 million of capital committed is without the fees, so the fees will come on top of that, so that makes it cheaper. So this fund is going to invest 33.3 times at equal interval, holds things for 5 years, usually it's more 4, but I made it 5, and double the money each time. Okay? That's the same numbers as the one Réal took, right? His investments were doubling in money. That actually turns out to be the exact average in the industry. Gross of fees in private equity, people double the money. And net of fees, a fund like CalPERS is at 1.55 times its money. So if you invest 100, you got back 155 after all fees. Okay? It's going to happen that on my example is exactly the number I'm going to get, and it's basically the number that Réal Desrochers got. So it's really very characteristic of, very representative of what CalPERS really got in private equity. So the management fees are going to be these 2 million a year for 5 years. Then we're going to change the basis, and they're going to add up to 18 million. Okay, he had 20, right? So with my thing, it's less than he estimated it, and it's down to a bit like the holding periods here that I could change to get like a different number. But I get a slightly lower number than it does on management fees. Okay. On carried interest, so the carried interest calculations are here. They are relatively simple with those examples. So you get 5.5 basically of carry every year, and you end up at a carry of 16. Okay? And he had 16 as well, right, on this example. So even here, I took into account an 8% hurdle, but there is a 100% catch-up, etc. So I end up with the same number as he does, even though my example is a bit more elaborate. If you make it more complicated, which is my top panel, you would end up with management fees at 19, so extremely close to his number, and a carry at 16, spot on his number, and so for a total fee of 36 for that fund, right? So the fund had 200 before fees, right? After fees, the fund is going to be at 1.64, but will have invested less than 100 because it would be subtracted from the fees. If you do the multiple here, it's 1.55. If you look at how much you gave into the fund and how much the fund returned to you, you have the ratio would be 1.55. On my example, this fund, after all the fees, gave you back 155 when you gave him 100. Okay? And that's exactly spot on. The average return of CalPERS historically is the exact same one for Oregon, which is also a very big pension fund who invested in private equity long ago, and it's a big allocation. Same number for Washington State Investment Board, which is also like a huge investor in private equity. Same number at CalTERS, same number at CPPIB in Canada. They all have basically this magic number. If you take any data in private equity, net of all fees, you're like a 1.55 of multiple. So basically, from his presentation, wasn't bad, was very simplified, couple of mistakes on the capital committed that was slightly misleading to say that, you know, it was like in any other asset class. But, you know, the numbers, I have the exact same one. Doing a more elaborate example, I have the same features, same magnitudes, etc. So the job well done. And the goal was to show like a character, you know, a typical fee structure, what happens, etc. And you know, we are there basically. Okay? So job done. So now, the board is going to ask some questions. Okay. Okay, so what's going on here? He's starting to sabotage his own presentation because he just said that he's presenting a typical fund structure with a typical fee structure, etc. And they ask him whether this is typical, and he says, no. Well, that's kind of was what we asked you to prepare, right? So, like, what do you mean it's non-typical, right? The short answer to the question is that, so if I had made my presentation here, and then, you know, it's also simplified my presentation, right? It's pretty stylized as well, and I have these numbers she is quoting, 36, it's split half-half, is that normal, etc. So I would have said, well, in my example, it is the case, but we have some studies out there that have large samples, and there is a main study in that literature is by Metric and Yasuda, and Yasuda is actually at UC Davis, so she's next door to them. They can go and check it out with her. You know, they find that it is exactly 50-50. And they find that the total fee bill is 36% of capital committed. That's there. It's published. It's clear on a very large sample. I turn out to have studies of this. I find exactly 50-50 split between management and carried interest. And I find fees of this sort of magnitude on a very large sample. It adds up with CalPERS number. They double the money gross of fees. And if you could look at net of fees, they are 1.55. Everything adds up. We know the answer. It's a very simple answer. To the question of Priya Mathur is, yes, that's typical. That's what my presentation was supposed to be. Okay? Instead, he said, I don't want that. We are not asking you what you want in life. We're asking you whether this is like that, right? You're not responsible for it, we just want to know. Okay? But he's very defensive, he gets very nervous, right? You can see that, like it starts like being like a bit nervous. And she's quite smart. She goes on and say, well, how was it in our portfolio then? Right? How much did we pay in management fees and how much did we pay in carried interest? How did that shake out in our portfolio? Here is the answer. So if you have a feeling he's not answering the question, then rest assured I have the same one. Now, the other thing that may put this a bit into context is that the short answer to Priya's question is very simple, is no, we don't know how it happened in our portfolio because we haven't kept track of it. We haven't kept track of it. We don't know how much management fees we have paid, because there has been all these waivings of management fees and so on, and they were taken from some other ways that we will touch upon if we have a little bit of time. But basically, we had difficulties keeping track of the exact management fees we've paid, and the carried interest, we have absolutely no idea. Zero whatsoever. We have never kept track of the carried interest. That's the answer to that question. It's a very simple answer. Basically, what just happened is that, so instead of answering the question that he was supposed to answer, he talks about this skin in the game, right? He says, oh, but the manager needs to put money into the fund. He needs to put 1 or 3%, and so that would be, making the person work hard. Okay, good. And then, therefore, she says, like, is it sufficient? And then he says, well, I don't know. And then she continues, and she says, well, is it possible, so clearly she knows a bit of stuff, she says, is it possible that people use the management fee to pay for their own contribution in the fund, and in which case it's not too much of an incentive? What she refers to is the fact that instead of people putting actual cash in their own fund, they actually convert some management fees into their own contribution in the fund. Okay? And he doesn't understand her question. He answers something else, and then the CIO, this guy, steps in and said, that's not the answer, it's another one. And then he's going to talk now about like why the IRS is not too impressed with that, and blah, blah, blah. But the bottom line, indeed, she was spot on, saying that, in fact, these own contributions are often some management fees that get converted into own contribution, and that has, again, the effect that if you keep track of your management fees, like at CalPERS, the number you actually paid is not the one that you did, because some of his money was used to be a capital contribution of a GP and wouldn't be flagged as a management fee in your accounting, okay? Basically, in this example, an investor got 200 from a 100 million investment. There was 36 million in fees in my calculation, like in his. If it was done on a yearly basis, this would be a much more meaningful number. We are talking about 7% a year. There's absolutely no asset class out there that charges 7% a year for an average fund, average performance. Returning this is equivalent to 12% a year net of all fees. Okay, so that, if it would have been more, interesting maybe to put it as annual numbers instead just of magnitudes. Priya Mathur was saying, wow, 36 million sounds like a big number. Well, it is, but if I tell you 7% a year and you compare that to the rest of your portfolio, that has yet another impact. That puts things even more in perspective. There are all kinds of fees that you need to add, in fact, to those numbers. So the key question one has to think is that, whether this is enough, if this compensation is fair or not, right? And so if the stock market returned 11% per year over the life of its investments, it is the case in the last 2 decades or any time period really you look at, then that looks a bit steep, because the stock market at 11% a year would have converted 100 million in 170 million over a 5 years period, right? Now it's very tricky, because here you paid like this 36 million of fees. You did get the same after all of these fees, but you have a big chunk that is fixed, meaning that if the market would have tanked, you would have still paid, or if the fund would have tanked, you would still have paid all these fixed management fees. But if the market was flat and private equity returned that kind of money, then indeed, then you can say, yeah, 36 is a good compensation. You may see it as fair, right? So that's how I would have presented it, and then we could have discussed with the board some trends, like they will in their presentation, that in fact, there are more and more offsets, that we are moving away from 2%, etc. So we can discuss the future, but the past fee structure is exactly like in this example and on mine. So let's go back to this presentation and go to the last point. Let me phrase the question of JJ, okay, and then tell you how you answer that question in 2 seconds. The question was, this fund has a fee of 1.5% of capital committed. We should have paid $1.8 million a year. And in that year, it gets millions and thousands, we're a bit wrong. In that year, they paid $300,000 of fees, and that's what is in the annual report. So you're saying, how come a fund was supposed to charge us 1.8 million, and then we report in the annual report 300,000? Is that, a typo? Right? The answer to that question is because they do not call for management fees. Instead, what they do is that they take the money directly from the companies they are running for us. Okay? So for example, if Blackstone bought Hilton Hotels with CalPERS money, Blackstone will go directly to Hilton Hotels and say, can you give me $10 million because I've been monitoring you and that's a lot of work. So then, and they control the board of Hilton Hotels in case, So then Hilton Hotels will just give 10 million to Blackstone, and then Blackstone will say, well, I just got 10 million now for monitoring, so I'm going to give you back 80% of that to you, CalPERS. So I give you back 8 million, and I keep 2 for myself for the work. And the 8 I'm giving you back, I'm offsetting your management fee with it, so I don't need to call management fee. I basically took it directly from Hilton. The investor is very happy with that because it goes to its boss and say, I'm just paying $300,000 a year of management fees, right? So now to that question, his answer should have been, well, yes, the way we report in the annual report is just slightly misleading because we've been reporting what we actually paid in terms of management fee and not what is due or what we actually paid, in fine. And so yes, that's a misleading number, and the fees we've been paying are much more, probably by a factor of 10, compared to the number that we've been reporting in our annual report, right? It's a tricky line to walk, okay? Now, I would have walked it if I was him, because he's new, he has just been appointed, so you're not responsible for that, reporting. So I would have walked it. I would have said, this is how LPs have always done it. Yes, it's highly misleading, and we are happy to correct this going forward, and we will try to get the information, because it's very hard for LPs to know how much they took from Hilton's hotel directly, so if they will need to collect all this information to find out how much fees they really paid, because they don't know. That would have been the right answer. Instead, he's going to go on for 15 minutes where JJ is going to tell him, but this is misleading, and because we have paid management fees of effectively 1.85, but you're reporting only 300,000, and then he will keep on saying, no, we pay management fees of only 300,000. And then JJ at one point will say, there are right pocket, left pocket. Here, 300,000. Here, 1.5 million. Okay, right pocket, left pocket, we pay 1.8. Okay, like why is this not in the annual report? Okay.